Yeah, so when you go to buy your first owned home, trust me, it's complicated. When I first bought my home, it was before I had my CFP, so it was all new terminology to me and it was all very overwhelming. So I'm going to give you three. The first one is amortization, okay? This is the length that your loan is for. So if you have a 25-year amortization, that means your loan is for 25 years and it will be paid off in 25 years as long as you keep up with the regular repayment schedule. The second term is principal. So the principal is the amount that you actually borrowed from the bank. So when you hear people say, oh yeah, I put an extra 10 grand on my mortgage principal, that means they put an extra 10 grand on the loan amount that they owed. And the third one I would give you is term. So when you go to buy a mortgage, there's going to be different term lengths that your interest rate is locked in for. So for example, you can have a 1-year term, a 2-year term, a 3-year term, a 4-year term, or a 5-year term. So what that means is if you pick a 1-year term, that just means that your interest rate is going to be basically not guaranteed, so to speak, but it's going to lock in your interest rate for that year. So I'll break it down a little bit further. So when it comes to your terms, generally speaking, it is just tied to your interest rate. How long are you going to have that stated interest rate for? And then it's broken down into two separate categories: a variable interest rate or a fixed interest rate. So if you choose a fixed interest rate for a 5-year term, that means whatever your interest rate is, it's going to stay like that for the next 5 years. Whereas if you choose a variable interest rate, your interest rate is going to move as the Bank of Canada does their interest rate announcements. So if you hear on the news, the Bank of Canada increased prime by 50 basis points, that means 0.50%, which also means your mortgage interest rate went up, likely 0.5%. So it's really important, if you do choose a variable interest rate, that if interest rates go up, you are in turn increasing how much your mortgage payment is going to be. Because if you don't, and interest rates go up, that means more of your mortgage payment is going towards your interest and less to your principal. So of course you're going to work with a mortgage specialist. Being a certified financial planner, I am licensed to talk about mortgages. I am not licensed to sell a mortgage. So my role is to help clients understand the nuances and how mortgages work. And then when they're ready to apply for a mortgage, I'm referring them to several mortgage brokers that they can work with.